Welcome to Option Trades Today. I'm Tony the Baptista, and I have a trade idea for you today. January 30th, 2024, but let's see what the market's doing. Even the S&Ps, they're down $3.50. NASDAQ is down $66, and the Russell is down $16. These are all relatively small moves. Maybe the Russell having a little bit of weakness, down almost 1%, and the Dow bucking the trend up almost $3. Volatility, which had been over the last couple of podcasts you've been watching here, catching a little bit of a bid, still going sideways, hanging out at 1408, but down 12 cents. Let's take a look. You know what I like to do. I like to go to my high option volume list. I like to forget about earnings, so I put my list in order when it's times for earnings like we have today, so that all of these stocks on top are the ones with the least amount of, that don't have any earnings. And everything else is below that. You'll see today you've got, we had General Motors come out this morning. You have AMD coming out this afternoon. AMD was one that I really looked at to put on a trade here. The stock's only down 65 cents. It has been hyperbolic. Volatility is off the charts here, but I'm not going to break my rules. I'm actually going to go into two stocks that have had earnings. The first one is IBM, still has an IV rank of 31. You can see here the IV rank is down the bottom right. You'll notice after earnings, the IV rank typically goes into the single digits, around 10 to 5 to 15. Let's just call it 10 as the mean. It's 31 right now, so you still got good implied volatility in Apple. And from our research, usually stocks go sideways after earnings for a little period of time. So I'm going to try to take advantage of that. I'm going to go to March because March has 45 days. 45 days is optimal for placing a trade. I'm showing you here that there's plenty of volume on each side. Let's change this from volume to probability of being in the money. What am I going to do in IBM? You know what? Believe it or not, I remember when there were a lot of $30 and $50 stocks, and a $100 stock was relatively inexpensive. Today, under $200 is an inexpensive stock. So I'm going to look to put some buying power to use here. I'm going to look to do a strangle in IBM. I have two trades for you today, so stay tuned. I'm going to do the 180 put. That's right around that 20-ish, 25-ish delta. And I'm going to do the 195 call, which is approximately the same. This is about as delta neutral as you can get, less than one delta on this trade. I did this at 342 just a few moments ago. It has a 62% pop. The theta is almost $8 a day, and it's completely delta neutral, with my assumption, and from our research, that the stock will go sideways post earnings, meaning that earnings have already happened. Pretty much a delta neutral trade that gets us right to around our one standard deviation move. That's why you have approximately that 60 to 65% pop. 342 is the credit I received. I wouldn't chase this. I would try to get filled around the same area. Let's take a look real quickly where and when I got filled on this. If you go down to the follow page, click on that, go to Bob the Trader with my smiling face, that's me, and you'll notice I got filled here when the stock was 187.43. Wow, well, that's where it is now. I'm sorry, 188.23. So you need the stock to uptick ever so slightly. And you know what? If you take a look at the market here, that's all it looks like it does is uptick. When I put it on, it had a 63% pop. You'll notice that I put in here a post-earnings strangle. That's exactly what we're looking at in high IV rank. What's the next trade? Well, if you've looked ahead here, you can see that my next one is Netflix. Let me not click on it just to show you what I'm doing. Netflix, also a post-earnings trade. Let's see what Netflix has been doing. It looks a lot like IBM and almost every other stock in the market these days. This is a $565 stock, even though it is down $10 today. It's had a nice rally after earnings. I'm expecting it to stay inside a relatively tight range. IV rank of 15 is not as good as what we saw in IBM. Still elevated relative. to what usually happens after earnings. And because it's almost a $565 stock, I'm going to use a defined risk trade here. I'm going to go into the same month, March. I'm going to look to do an iron condor in here. I'm going to go around that standard deviation. You're probably going to have to go a little bit closer to collect 1/3 the width of the strikes. That's what we like to collect. Here's the 520 put, 510, $10 wide iron condor. You'll notice I'm collecting around $1.53 on the put side. I want to collect around $3 on the overall spread. $3 on the overall spread is 1/3 the width of the strikes of the $10 in risk that I have. On the call side, let's go $100 higher on that side. So we'll go to the 620, 630. Have a little bit of call skew in here, and you'll notice that this is trading at $3.03. I put this on at $2.98. I did get filled about 2 cents under mid price, so you might be able to make a penny, or you might be able to put this on a penny or two better than I put on the trade. Same probability of pop on the trade that we just had a moment ago, 63%. My theta decay, as you would expect, since it's using significantly less buying power, $700 in buying power, or 702, meaning that's my risk. The risk is the inverse of the credit that I sold this for, and the width of the strikes. You add those two together, that's going to equal $10 on the overall spread. My delta is completely delta neutral, less than 1 delta. My max profit, obviously, exactly whatever you sell it for. What's reasonable for a trade like this? Well, I'm looking, and you'll notice here, I'm looking to collect around $1 or so on this overall trade. I'm outside the expected move. The expected move is this orange line here. So I'm hoping to keep this on volatility to continue to contract or stay sideways, or at the very least, not move outside of the expected move. Let's go back to IBM for just a quick moment there, because I didn't tell you how much buying power you're using on that trade. That trade uses around $3,800 on that trade, for almost double the amount of theta decay between the IBM trade and the Netflix trade. Now you'll notice IBM has has a monthly implied volatility of 18. Let's take a look at real quickly Netflix. Netflix has almost double that of almost 30. Still relatively low on both sides. IBM, when compared to Netflix, looks like it has a higher IV relative to itself, even though the monthly implied volatility in IBM is much lower than Netflix. That is IVR in a nutshell. IVR rates the implied volatility, monthly implied volatility of that product against itself, spits out a number that gives you a range from 0 to 100 on where that volatility ranks right now, here and now. All right, you know what else you can do right here and now is open, move, transfer, take your account to Tasty Trade, help us keep the lights on here, and help you put some money in your pocket by taking advantage of some of the great promotions that Tasty Trade has to offer. They're giving away cash.